Hey, Andrew Faldy here, and I want to tell you about the simple once per month investment model with 5 times the risk-adjusted returns of the stock market. So we call this the target volatility models, all right? And that's plural because there's a lot of different ways to do it. But what I want to show you right now is the simplest one, the absolute simplest one, all right? And so target volatility models are presuming some things. And it presumes that recent realized volatility is an indicator of near-term expected volatility. All right, what does that mean? That means if the market gets more volatile, then the market is risky. So if prices are moving around more than usual, then the market is currently more risky, and you may just want to be in a smaller position. And if the market is less volatile, price is not moving up and down as much, then the market is calmer and it's a safer place to be, and you could have more of a position on, more into that market. All right, so put simply, an increase in volatility can follow through and be an early indicator of a larger correction. So what we're looking for is sometimes if not implied volatility, but the actual volatility, how much price is moving. If it starts to move more and more and more on a daily basis, that could be an early warning sign that it could get a lot worse. All right, and these things don't usually just have an immediate change. There's usually an incremental effect where a little bit of volatility leads to a little bit more, leads to a little bit more, and a lot more, and things can get really out of control. So we use those early indications to make small adjustments early on and to reduce risk. Okay, so that's all the theory. Let's see how this really looks. All right, so what you see on the chart is a period of time for the S&P 500 at the top, and at the bottom we have 2 different ways of measuring volatility. We'll focus on the lowest one, the yellow line. All right, so here you can see a spike in volatility. Now, just real quick, if you're used to seeing implied volatility, this is different. This is not about what the market is estimating or how much the options prices are. This is even simpler, far simpler than that. It's just how much the market's moving around. Okay, so this spike in the the actual volatility of price comes in, and then after that, you have the larger correction. Okay, that's what it's looking for. This doesn't always happen. You can even see just in this little example, this short period of time, that sometimes it doesn't happen. But it does happen often enough that it can be a great warning sign for us. All right, then we see that when the volatility of price drops, that what can happen is the market's getting calm again, and then the period of time after that could be a general rise in value. Okay, so that's what we're basically looking for. That's the concept. All right, but here's the really important thing. Can we actually use recent volatility to reduce risk and improve returns in a portfolio? All right, it's not enough just to say, here's one example or 2 examples of how this could work, or does this sound like a great idea? Let's really just find out. Let's put it to the test. Let's look at decades of data and information and see, does it actually make a difference? All right, so let's start with a base. All right, we'll just say, what does it look like to just buy and hold the stock market? Okay, and for this, the very good representation of that is just the Vanguard 500. And this, we have data from the beginning of 1987 through basically the end or near the end of 2019. All right, so nice long period of time. And you can see in there crashes. You see the crash back in 1987. You see recessions. We have 2 decent sized recessions that are reflected in the value of the stock market. Okay, so that's the base. And if we can improve our risk-adjusted returns over this using something as simple as the volatility to change our sizing, then it may be worth continuing to look at it and use it in the future. All right, so this is just step 1. All this is, one single change to that is to use volatility-based sizing. All right, so just by taking the same markets, the Vanguard 500, but once per month, just once per month, we change our size to be smaller size if the market's been more volatile and larger size if the market has been less volatile. Look at the massive difference. We don't see big crashes. We don't see very, very large drawdowns during those recession periods. We see a much smoother and gentler up and down. Okay, so I'm going to go back and forth one more time so you can see that. So this is the buy and hold, and we can see the crashes and the deep retracements in value from just hanging on full size all the time. And then this is adjusting our size once per month, how much of the stock market we hold based on how the volatility has been over the last month. Very simple, all right? Then we're going to take it to another step. We're going to go to step number 2. And step number 2 is, what do we do with the extra money? All right, we have a smaller position when things are quiet. Or I'm sorry, let me say that again. We have a smaller position when the market is volatile. We back off a little bit. But what do we do with that extra money? We just let it sit around? Well, that's what the previous one was doing. This one, what we do is, when we have a smaller position because the market's crazy, all right, it's been more volatile, price has been all over the place, we take that excess capital and we put it into bonds. How simple is that? Really simple. So what you may not be able to see right away, though, it's a little more ups and downs. Really, part of that is we're just in 2 markets, so there's a lot of different things happening at the same time. But in general, it's a much straighter, continuous line. Let's go back and forth so you can see that. So you can see here, generally a little bit smoother as it goes. 2 things: the total return is less, and you still have those periods where there's a lack of performance, sideways total returns or negative returns for years on end. Then we go to a 2-asset portfolio, just 2 assets, stocks and bonds, using volatility of the market to dictate what we're in. And we can see here, there aren't lengthy periods of time. It's short periods down and back on our way. Short periods down, back on our way. Sideways for a little bit and then back on our way. All right, and then also at the end, we see the total return is higher. Previously was less than 250 total percent gain over the entire period, and this gets us to over 300%. Okay, so now what we're going to do is we're going to compare our very first chart to our final chart. The first chart was just buy and hold, and the final chart is step 2 of our volatility sizing, which is changing our size in the stocks and using the extra capital in bonds. All right, so here they are put together, overlaid. So let's start all the way at the beginning and see what happens here. 1987 crash in the market. We don't see much registering. We have some little bit of volatility in the portfolio, but not that bad. Stocks are very, very strong through this period of time, kind of outperforming what we would have seen. And then even for a very long time, really getting far above. But what we see is when it finally tops out and stocks do poorly for a long time, deep drawdown for multiple years and 0 return for 5 or 6 years before it finally gets back above and then comes back down again. What we see is that steady, consistent gains from stepping aside during volatility, being in bonds for the income and diversification throughout the rest of the time. And look at this. Look at the Great Recession, the financial crisis. What actually happens here? A gain. We're actually in a gain because we were reducing size in stocks, going into bonds during that period of time, and we actually come out a little bit ahead in the midst of the financial crisis, experiencing, instead of a rapid recovery, just a little bit of sideways and then moving back on. Very, very powerful and very simple. Okay, and then net at the end of the day, at the end of the whole period, not a significant difference in total return, considering how much less volatility there is. All right, so let's look at the stats a little bit, just really high level basic stats of how this looks. All right, so on the stock market side of things, average, so the gross average return, the simplest way to put it, like what is the typical average year look like? On average, a little over 10% a year over this period of time. worst year, by the time the year was over and measuring from beginning to end of the year, 37% negative 37% in the stock market. And then the peak drawdown, where there could have been some gains prior to the big drawdown, then a little recovery. So this really is a better measure of risk than just how the end of the year wound up. The max drawdown, 50%. That's the stock market. That's the stock market. That's why 2-to-1 leverage is a way to possibly blow up your investment account. To just 2-to-1 leverage can blow up your investment account, because the expected max drawdown of 30, 40, 50% or more is possible. So that's the stock market. Now let's look at our volatility model, and this is going to be the one where we're looking at stock market but volatility sized. So backing off when things are risky, being in a larger size when things are calm, and then using the extra capital into the bonds. All right. And so the average annual return there is just a little under 8%. All right. So I know it looks like it's like 10 and 7. Well, what it really is just a little more than 10 and just a little less than 8. So it's really actually about a little over 2.5, about 2, I don't know, 2 point. Let's figure it out. Generally, I believe you shouldn't have to go to the decimal places to decide if something looks good. I just feel like these, numbers, 10.39 minus 7.94. Keep doing that. 2.5. All right, so 2.45% different per year. Not a big difference. And the worst year, 4.67%. Only down 4.67%. That is a very big difference. 37 divided by 4.6. That's 8 times less risk. 8 times less risk on an annualized basis. And the max peak to trough drawdown. So the highest value that you ever saw things drawn down to the lowest amount before it recovers and moves back on. That's called a max drawdown. 10.51%. About a fifth of the total peak to trough drawdown risk, and an eighth of the annual realized risk of the stock market here. Really, really powerful stuff, especially considering how simple it really is with a once per month management. Okay, once per month, you get in, you look at volatility, you figure out your size, you change the size, you reallocate a little bit to bonds. Very simple. And it's easy to add something like this or supplement with other investments and investment strategies you have and trading strategies that you have. This is a great core base type of allocation methodology that you can use. You can have some stuff that it's always buy and hold, just hang on. You can have stuff that's directional. You can be long and short. You can be doing income trading. You can be stock picking. You can do all sorts of things. But you could add this in, and usually what we see is if you have other things that have positive expectancy, you expect to make money year after year, year in and year out go by, you expect to make money doing other things. Well, when you start mixing them all together, things get even better. They improve even more because it's more diversification. All right. And further improvement is available even above this with additional diversification and hedging. And I've even got models. We start getting into 3 asset models. We start getting into directional filtering, and things get even better, but they get a little more complicated. We can keep it as simple as this and have such a big improvement in the results. All right. So if you want to learn the details about this, what do we use to measure volatility? What are the settings? How do we do the math? How do we calculate the position size? What is the representation of the bond market? How do we get to a 3 asset model? How do we start adding directionality? Okay, so we have all of that information, and that's all in the details. And what we have is, it's called the active investing series. The idea of active investing is we use investing principles. We use the ideas of just being in the market and having core positions, but being active, being a little bit, applying a little bit of intelligence to asset allocation, to hedging, to diversification, to correlations and sizing, all that stuff. Just get active with really good stuff, not just opinions and predictions, but just good information, good models, good things that have worked for a very long time that we can apply. All right. So to learn the details and get the active investing series, that's included with our membership. We really only have one thing. We have membership. You can come and join us and you can learn what we're doing and be a part of what we do. And with membership, you have basic training. So it's going to talk about investing, trading, options, futures, commodities, all sorts of things. All the basics are covered for everything that we talk about, all the different types of trading and investments and portfolio management concepts that we do. All of it's covered. And we have a community, because why would you want to do it alone? Why would you just want to read a newsletter or watch some videos or read a white paper and then just try to go out and figure it out on your own? We do everything in a community. We have individual traders who have thousands of dollars in their account, and we have money managers with tens of millions under management. And we're all in a community, and we all are actively improving from wherever we are. We're improving from where we are to the next step. And by doing that in community, people can share from each other's strengths and share ideas and get ideas from each other and ask different questions. And you can learn from the questions that other people are asking. And it's a wonderful, important value that we add to what we do. And then we have strategies like the one I just showed you. Details, step by step, on how to do these things, and all over the place. If you want to be in just investing in stocks, you want to be options income trading, you want to be in commodities, you want to be in very complex portfolio management concepts, do you want to be a discretionary trader who uses strategies that show you what works, but then use your own discretion to pick and choose what opportunities you want to take and how you can add value using discretion, and lots more. All right, so all of that's included, and we believe all of it's important. Instead of just picking and choosing this and that, we just make it a very simple, you have a membership and you can see everything and you can learn from everything and then go and apply it the best way that you can. All right, so I know it sounds like a lot, but it's actually really simple. And here's how it works. You just come in and start with a trial. And how that works, you come in, we have a very discounted, cheap, easy, low risk way to just come check it out. Come check out the community and the training and the strategies and everything we're doing. Live meetings, all the stuff we do. All right, come check it out. And if you like it, you can stick around. That's it. All right, so instead of like a big upfront cost where we promise you the world and we tell you all the things you're going to get and you got to fork out a whole bunch of money, we say, no, keep the risk small. Come, just take a look. Come see for yourself. All right, and I'm convinced that you're going to be very impressed, and you're going to find this to be in addition to your trading and investing that you're not going to want to get rid of. And if it's not a good fit, that's fine. That's absolutely fine, and no hard feelings or anything. It's super easy right inside your profile. You can just cancel during the trial. Afterwards, one step, you just say, want to go ahead and cancel or pause what I'm doing here? No problem, we'll take care of it. All right, so hope that you decide to check it out. Come see what we're doing. And remember, we're very active. So when you come in, ask questions, and I look forward to helping you get the answers you need and helping add value to your trading and investing. All right, thanks for watching this, and I'll talk to you soon.